Okay, good morning, everyone. Um, we're here in New York in our offices in Wall Street, and I'm very excited about this uh, call, you could say, because it is the first attempt that we are putting in place in order to communicate with our base of investors in a better way. So we are trying to do this in two languages because we have a strong base of international investors that are Spanish speaking. And we also have investors, in 22 countries in total that are obviously English speaking. We try to do it in native languages in a number of cases, but that proved to be very complicated. So we're sticking, to English and Spanish. And obviously, this is the first one we do for our project 17 John. We want to do this on an ongoing basis for all the projects we have, and we feel that it is good, to be updating you as to what is going on and our perspective on the economy and what's going on with the company and where are we in terms of the different projects, and specifically 17 John for this case. So every quarter, like I said, we're going to be having this call. And on this one, I would like to start by giving you an update of where is it that we are in terms of Prodigy Network. As I'm sure you already know, we have over $1 billion in our portfolio right now. Here in New York, we are on our 5th project. We have AK United Nations, excuse me. We have AK Wall Street. We have 17 John. We have Assemblage 25th Street, and we have another Assemblage in Park Avenue South down the road. We have gotten financing from Deutsche Bank, CIBC, and Bank of America. And we also have financing from a pension fund administrator formerly called MS and now called Bombard. We see how the projects have been unfolding very, very successfully. And that is very good, for the validation of our hypotheses. If you remember, you invested particularly on the fact that we were providing you access to projects that were privy to the very wealthy before. Projects like probably the one that you see in the back of my window over there. And in those projects were the ones that were selected in 2007 by the wealthiest investors and the institutional investors, precisely because they provided the most protection and the preservation of capital for them in the worst crisis that we have experienced since the Great Depression. So we decided to focus on those type of assets thanks to a combination of two things. Number one, technology. We believe, Davos explained in the World Economic Forum, Davos was explained that we are in the verge of the fourth industrial revolution. And that fourth industrial revolution, after the first one, which was in 1787 with steam, and the second one, which was with electricity and the automatization of processes, then that led into the third one, which was the technological revolution and how everything was truly automatized. And of the third one, we started with the fourth one, which is essentially what we have today. Billions of people connected through mobile phones, just like this one, with incredible processing power and at a very impressive velocity. So that internet of people enables incredible things, like the fact that now investors from 22 countries in over 25 different states in the United States can invest in specific assets like the ones we have here in New York. And that proved to be the safest ones and the more resilient ones in the crisis of 2007. So I wanted to take this opportunity to share with you that we completed our first project in New York, thanks to that technology, and thanks to also the law that passed in 2013 that enabled the open solicitation so that I could have these type of conversations and the advertising that we do to solicit our accredited investors in the US. The combination of the law and the technology that I just explained effectively created this opportunity to provide access to smaller investors like yourselves to participate in this type of buildings that have a proven track record going backwards. We like to invest not in hypotheses or in theories, but in realities. And an unquestionable reality is that these assets have proven to be very resilient, and anybody can check the data, and anybody can go online to see how those were the selected ones because of how predictable they were in the crisis. Later on, the economists called it the flight to quality, where essentially investors looked for treasuries, gold, and commercial real estate in the largest cities in the United States. And obviously New York is on top of everything because 56 million people come to the city every year. So that effectively creates an incredible demand for rent in commercial buildings. Now, it is important to clarify that investors didn't put their money in multi-asset funds because those funds were clearly correlated with the volatility of the stock market. And while the performance of the underlying asset was very good, or the underlying assets was very good, the stock of the REITs, fell substantially, as did everything else in the stock market. So people look for discrete specific assets like the ones we bring to the table. So in a nutshell, crowdfunding is about a very simple premise. Everybody thinks that it is a novel concept, but it is not. It is traditional syndication where you put a bunch of investors together, smaller investors, thanks to technology, and you provide them access thanks to the law as well that enables that to happen right now into buildings that have a proven track record. So that theory was proven in, excuse me just a minute. That theory was proven in last year because AKA United Nations, a building we bought in 2014 to later remodel it, was effectively completed. And the investors participating in that project that was originally financed by Bank of America and MS Bombardon as well, cashed out last month with a return of over 21% in dollars, net after taxes, which is something that certainly people have never seen before with an investment of an average of $50,000 a piece. So we're very happy and we're very proud to have proven that our thesis that later turned into a hypothesis was effectively turned into a reality in a very efficient way. So in an environment like this, when you put in context the returns that our investors made in that project is the perfect validation for crowdfunding. And we know now that it is a reality and certainly not a thesis anymore or a very good idea. And the second project that we have, which is AKA Wall Street, is coming down the pipe. And we feel that it will be ready and operational by April, which is next month. And it will be completely open by the summer. So we expect, to initiate the recapitalization to liquidate that investment on behalf of our investors by the summer too, and the returns are going to be consistent with what we expect them to be. So we're very excited about that too. In addition to that, we have Assemblage 25th Street, which is our project right now that is currently being funded. We're very excited to announce that we're also opening a whole new market for us, which is Asia, where we started getting leads in the website a few months ago, unsolicited, quite frankly, and the reaction has been very, very good. We have seen how the common problem of lack of return and lack of access from international investors to this type of asset classes that are different than stocks and bonds or residential real estate is very desirable across all the different geographies around the world. So in Singapore, in Shenzhen, in Shanghai, in Hong Kong, we have already a strong demand, and we are starting to explore an operation in Asia just to consolidate our business further. Right now, we also are entering into a growth stage in the business. We feel that after proving the model and having the portfolio that we have, we believe that the market is going to come our way. We see that with the current volatility and uncertainty in the world, people are looking for hard assets in dollars to protect, from that uncertainty, protect themselves from that uncertainty and from that volatility. And we want to capitalize on that. And we feel that we can provide a decent alternative that generates security in a potential downside, so that people don't lose their money. And it can provide as well a very important potential of upside, like AKUN just delivered. So in a way, as long as we focus and we keep the discipline of investing in these type of assets, we're going to be protected in the downside, and we're also going to be posed to enjoy the appreciation in the upswing markets. Now, having said that, we also see how this technology driven by the fourth industrial revolution is not only disrupting the way we're raising capital to provide access to investors to these type of buildings, but it is disrupting the buildings themselves. We see how the traditional office spaces are being transformed into collaborative workspaces or co-working spaces. And that industry has been growing beyond, I have to admit, my wildest expectations. It seems to be that the phenomenon is global. It seems to be that technology is disrupting not only the way we transport ourselves, like with Uber, but also the way we travel with Airbnb and the way we work now with collaborative and co-working spaces. So the rent and the projections are just stunning, and the potential demand, obviously in cities where with that dense population is mind-blowing. So we're focusing strongly on assets that effectively provide cash flows that are consistent with where the world is going. So we're shying away from condo, because we believe, that people are going to be renting more and more. And we believe, that they're going to move strongly into the co-working market. And we feel that we have a very good opportunity to capitalize on that market and cash in those very solid rents. From another angle, we also see the disruption in the short-term rental market. New York is probably the most desired market for short-term rentals. A bunch of people coming to New York, out of the 56 million, are willing to stay here for more than a week. And they don't necessarily want to do it in a hotel because of the breakfast in particular. Excuse me. In the short-term rental market, the key is that you have a kitchen and you have a separate living room other than your room. So that gives you the idea of enjoying the city like a local. And when you come here for work, we have estimated that a good third of the 56 million people that come here to New York every year do it, for extended periods of time. And by extended, I mean, more than 2 nights, but certainly less than a year. And they prefer to be in this type of properties or in apartments rather than in a hotel. So that has driven the success of Airbnb, which clearly is taking a good bite of the hospitality industry in Manhattan. But they have a problem, and the problem is that they are not fully legal. And they let's say that the opposition has a few valid points. The most important one is safety. When you come to these places, no one can really guarantee your safety, personal, or for fire hazard or stuff like that. And the second one is that they're not really paying taxes, so the city is strongly opposing them. We just decided to develop extended stays that are fully legal and that are operated by professional firms like AKA. So that in a nutshell gives you an idea of why we do collaborative workspace and why we also focus on extended stay. Now, having said all of that and understanding that we believe that in a market like this, with the uncertainty that we see, we believe that the market will come our way as investors look for the security of a specific asset that they can see, and with a very predictable cash flow that was proven, in a deep crisis like 2007. We need to understand as well that the world is different than what it was in 2015. I feel that since August, everything has been changing substantially, and we need to be very cautious about it. And even having this opportunity that I explained relative to where we see the market going, we still need to anticipate potential problems and run stress tests like we do all the time in our projects and see what if things don't turn out the way we expect them to be. And that's precisely, what I wanted to talk to you about relative to 17 John. And here is my take on things. In the world economy, my crystal ball, which is as good as everybody else's, essentially shows me that the commodities market has been badly hit, precisely essentially for China and the slowdown in China. But you also see the energy market, and the oil going down in price from north of $100 to less than 30 and stabilizing somewhere there temporarily. You also see how the dollar jumped, against many countries and many currencies by a good 30% and sometimes even more last year. So you have an energy crisis, you have a commodities crisis, you have a currency crisis, and then you even have a geopolitical crisis with the escalation of terrorism and how, people are feeling a certain degree of fear that they didn't feel before. With all of that, we also see how the domestic U.S. is very resilient. We don't have the leverage levels that we had in 2007. People have deleveraged substantially since then. We depend on the domestic economy and the domestic demand, essentially. And we don't depend on the international economy as much. But we're still in the world. So there's a certain degree of isolation, and that has translated into recent stability over the past 5 weeks in the stock market. But I certainly think that we cannot discard the potential impact of the slowdown in the world economy into the domestic U.S. economy. So how does that affect, our business? If there is a slowdown or a spillover from the international markets that affect the U.S. economy, the rents may be affected as well. Essentially, people would travel less. and you may feel an impact on the cash flow generated by the projects. If that is a possibility, or if we see that even in our most conservative scenarios, that may happen, we have always taken the position, that before maximizing our returns, we have to protect the capital of our investors. And I just don't mean that politically. I mean that practically, not only because it is the right thing to do, but also because it makes business sense. We are not here to do just one project. We are here for the long run, and hopefully we're going to be making many, many more projects. So we are facing a potential in the markets, okay? And the probability has reduced substantially, as I said before, for the past 5 weeks. What do we do relative to the project where you invested in? If there is a higher potential possibility of a somewhat of a slowdown in rents. So the first thing we say is that we philosophically shift, and we shift from maximizing our returns or sponsors into creating greater levels of protection for the capital of our investors. And that translates into very simple measures. You have what we call a waterfall. That means that you have a preferred return of 6%, and then we go 80-20 up until you get a 15, and then after that we go 50-50, which essentially means a bonus to us. Now, we designed the model for the project to maximize your return, but to also maximize our return, which essentially means that 50% in the back, because the 20% before the 15% is going to be not that much. However, like I said before, I think, we had to reevaluate, the way the project was conceived in the previous market, because we are clearly, even if we understand the level of isolation that the U.S. economy has, we are still, in a different market no matter what. We may be, like a friend likes to say, the tallest midget in the room, but we're still part, of the same world. So the measures, with of caution that we decided to take was to essentially reduce the leverage in the deal. And I want to go over the changes that entails. The first, we had a project, that was essentially going to be an existing building with 110 units right there by the Fulton Station in 17 John. We wanted to do, because we have the air rights, 8 stories of a glass building on top of that is fully designed. We have a Dwayne Reed that is paying us $1.2 million in rent every year in the main level. And we have a bar in the basement that is also paying us like $200,000 in rent every year. We have $50 million in equity from investors like you from all over the world. And we have a potential loan of $170 million for, again, a total cost of $220 million. The expected IRR to investors was 15 to 17%, and the exit was projected for 2018. So that is, in a nutshell, the project we have as it is defined right now. Again, very quickly, $220 million, $170 million in debt, $50 million in equity, and a projected return between 15 to 17% and an exit in 2018. Now, in the new world, I don't feel comfortable with a loan of $170 million in a project like that. So we said to ourselves, what if we do a smaller scale project that may sacrifice a good portion, of the promote or of the revenue coming to us in lieu of a greater safety for the overall financing of the deal. And what we did was this. instead of doing a $220 million project, we are not doing the 8 stories in the building of the new construction. We are keeping the existing building. We are keeping the Dwayne Reed in because it is paying us a hefty rent, and that translates into an interesting valuation in the overall cost of the project. We are keeping the bar in for the same reason. And in the existing building, we are doing 81 units for the extended stay or short-term rental program that we wanted to always do. And we are doing 5 floors of collaborative workspace in the pedestal in the building, reducing the number of units from 110 to 81, and 5 floors of collaborative workspace, which is roughly 45,000 square feet. So we scaled down the project. We don't do the 8 floors of new construction. We keep the existing building. We turn the 110 units into 81 units plus 5 floors of collaborative workspace. We keep the Dwayne Reed in, and we keep the bar in. By doing that, this is what happens. The loan, first of all, the overall cost of the project goes from $220 million to $165 million. And the loan goes from $170 million to $105 million. So it's $65 million of less debt that we put in a project like this. And that makes us feel very, very comfortable in terms of the protection that we are providing to you and to us as well, in case that there is a potential slowdown in the revenue derived from renting those apartments and selling the memberships for the collaborative workspace. Some people may say that I'm being overly conservative, and they may be wrong, but I wouldn't like anything more than to be proven wrong, in this conservative stance. I hope that when we deliver the building in 2018, oh, by the way, obviously that has another positive point to it, which is the fact that with less construction, we not only have less debt, but also we can deliver the building by probably, I would say, 9 months earlier than what we had originally projected. So we believe that this building is going to be cash flowing not in 2018 as we originally had projected, but probably by the summer of 2017. And with that in mind, I have to tell you that I feel much more comfortable because I would be anticipating a slowdown. And if it happens, I want to make sure that we, like I said before, are bulletproof. And that only comes, with a lower level of debt, that you can be certain that the cash flow of the project is going to be able to sustain and service that. And if I'm wrong, the appreciation is going to be much greater. So we win by not losing capital, which effectively, in my mind, is the first reason to be investing in this type of deals. We expect the return to be relative to you, as you have that protection of the 6 and the 80-20 before the 15. You are going to be receiving, I would project, the same returns that we expected before. We, on the other hand, as I said before, we're sacrificing a bit of our 50% in the back in lieu of providing that delevering and that better protection. But I think, it's the right thing to do. It feels much better. And like I say, if we take care of the real estate will take care of ourselves. And that essentially happens by having an amount of debt that you are comfortable in covering, And I believe, that in an environment of uncertainty like the one we have, while we have had, very positive news over the past 5 weeks, I still believe, that it is a very, very volatile and uncertain market. So I want to make sure that we follow the example of the large investors in 2007. If there is a crisis, if it isn't, great, like I say. But if there is a slowdown, I want to make sure that we're able, to protect the integrity of our collective capital. Because as I said, that's the main reason for us deciding to choose these assets. We invested in these assets for protection and then maximizing returns and the wonderful potential combination of both. So as long as we have a level of debt that is manageable, we will be fine. And that's essentially the change in the project that I wanted to communicate to you. And I have already spoken individually to some of you, and I believe everybody concurs that delivering the deal in a market like what potentially can ensue is essentially the safest bet. Like a friend told me the other day, if it wasn't because I invested in the assets that Prodigy brought to me in 2015, I don't know what would have happened, with my portfolio and what happens in stocks and bonds. So I want to make sure that we keep consolidating, our reputation and our business consistent with the market fluctuations. And whenever we can maximize returns, we will. But I feel that right now is a time to protect the integrity of our capital and anticipate, potential problems down the road. And again, it feels right because if I am wrong, great. I'll be the first one to admit it, in a call like this. And I hope, that you communicate back so that it is a two-way avenue and not, one directional. And feel free to email me directly. My email is rnino@prodigynetwork.com. And I'll be happy to entertain any conversation or any questions you may have. So I think that I don't have anything more to share with you for the moment. And thank you very much for your attention. And I look forward to talking to you again, or either by this way or in person whenever you come to New York. And again, please feel free to contact me if you have any questions or any comments relative to the changes in 17 John. Bye-bye.